stock, Telstra. Give us some thoughts on the result that we got out today. Shares aren't online yet, so we'll get a look at that in a short while. Give us some numbers and what you thought.
Brooke, this is Australia's largest telco, making up 46% of the Australian mobile market and 95% of the fixed line market. So looking at the results, it's the mobile division which now makes up a large chunk of revenue. And it was quite interesting having a look at the statistics. I mean, having a look at just mobile-only households now, that's actually increased up to 2% to 14%. So 14% of households in Australia, 14% of households in Australia are mobile only without a fixed line now. We also saw 1.6 million new mobile users, so some good acquisition numbers there. Revenue is up by 8.5%. So revenue from that mobile business now makes up 1/3 of Telstra's revenue. Data and IP, though, we actually saw a decrease of 0.8%, and that's probably more a reflection on the macro environment. So a little bit of softness there, but margins extremely fat. If we have a look at the EBITDA margin there, 64%. And of course, we know that the fixed line business has been decreasing. All in all, the results in line with expectations. Revenue was up by 1.3%, EBITDA was up by 2.1%, and we saw free cash flow of $5.2 billion coming through. If we have a look at FY13, I think a good outlook coming through from Telstra. But of course, this is a stock that reached a high of $4.09 for the year earlier on in the month. And we have seen this rotation from some of the defensives into the resource plays. So it looks like the result, while in line with expectations, we may still see a little bit of weakness in Telstra shares because investors do seem to be shifting away from the Telstras and the Tabcorps of the world into some of the resource stocks.
Julia saying we can't give forecasts on whether we can keep to last year's pace of customer growth into this current year. Again, another question mark.
And that's because mobile customer growth has been absolutely outstanding in the last couple of years. We've seen 3 million new customers being added to that mobile business. So to be able to sustain that rate of growth in a population of about 22 million is astounding. 3 million new mobile customers, but they will be investing more in new infrastructure. It does look like capital expenditure plans of about $500 million over the next couple of years, and that's really to bring into force things like 4G. So it does look like an exciting time for Telstra. They have increased their capital expenditure expectations, and that's really why expecting free cash flow in FY13 to be between $4.75 to $5.25 billion. Still very strong and still very healthy, but it does look like Telstra are looking at capital expenditure now to try and spur on some of that great growth that we've seen in the mobile business over the last couple of years.
Telstra just come online. It is falling over 2%. Your immediate reaction, Gillian, to both?
I guess we have seen that, that rotation playing a part in both of these stocks. These are both quite defensive stocks, Telstra in the telco space, Tabcorp in the wagering and the gaming space. And if we have a look at these two stocks, really they haven't shot the lights out in any way. What we're probably going to see are the outperformers being in that material space. We saw a fantastic performance by Rio Tinto in both London and New York on the back of that first half result, and I'm thinking that we'll probably continue to see that rotation out of the defensives, which are looking relatively fair valued now, into some of those undervalued material stocks, especially given some of the commentary. The China numbers are going to be important for that because Rio Tinto did come out with some fairly bullish comments yesterday saying that they expect growth in China to be at 8% for 2012. We know that China's aiming for 7.5%, but we'll get inflation numbers, retail sales, industrial production, fixed asset investment all coming out today. So that's going to be an important one for the material space, and hopefully those numbers out of China will back up some of those bullish comments coming out in terms of Rio Tinto's first half results yesterday and that conference call. But all in all, it looks like that sector rotation that we've been seeing out of the defensives into some of the high beta plays really continuing, and that's a positive sign for the Australian market.
What specifically, Julia, did you think sounded optimistic in those comments from Tom Albanese at Rio?
If we have a look at the China growth forecast, Rio Tinto saying that they expect 8% growth, and China isn't growing at 8% at the moment. So I guess that signals a bottoming out in terms of growth expectations in the third quarter of the year. I mean, initially economists thought that we would see a bottoming out in growth in the second quarter, but of course the numbers have continued to be soft. So hopefully with some of the interest rate moves that we've seen in China, we start to see an improvement in the fourth quarter. So that 8% growth rate above what China's growth growing at the moment. And of course, we know that China is aiming for 7.5%. They do tend to be a little bit conservative in terms of their forecast for GDP growth. But today we'll be watching things like retail sales to see whether the domestic economy is holding up quite strongly given the situation in Europe. There have been hopes that that knowing that China's largest export market is Europe and that we'll probably see a bit of softness there, that China's domestic economy is strong enough to fill that gap. And really, I think that's what the market's going to be watching for. Also, inflation expected to ease from 2.2% down to 1.7%, which will give the People's Bank of China plenty of room to move in cutting rates. So I guess expectations are that if we do see a tame inflation result, that we will see more rate cuts.